Competition is a game for losers. It's a race to the bottom, a bloody, bare-knuckle brawl over thinning margins and fickle customers. The 99% of investors, the 99% of entrepreneurs, spend their entire lives fighting in that arena, believing that the key to success is to build a slightly better mousetrap, to offer a slightly lower price, to outmarket, outhustle, and outmaneuver a dozen other companies that are trying to do the exact same thing. They are fighting for scraps on a crowded battlefield. But there is another way, a path followed by the most successful capital allocators in history. It's a path that doesn't seek to win the competition but to avoid it entirely, to own the entire battlefield, to own the only road into the city, to own the bridge. Warren Buffett's most powerful and enduring investment secret isn't a complex algorithm or a secret formula. It's a simple, profound mental model. Find and buy a toll bridge. A business with such an unassailable position, such an entrenched advantage, that it can simply sit at a critical intersection of commerce and charge a fee for a necessary service, year after year, decade after decade. Customers don't have a choice. Competitors don't have a chance. This isn't about finding the next hot tech stock or timing the market. This is about a fundamental shift in your perception of what a business is. It's about transforming your stock-picking process from a speculative gamble into a strategic acquisition of economic fortresses. You will learn to identify the modern-day toll bridges, businesses with impenetrable network effects, government-granted regulatory advantages, or unique, irreplaceable assets. These are the companies that generate effortless, high-margin profits, the kind that build dynastic wealth. Forget the noise, forget the competition. Prepare to learn how to find the toll bridge stocks that print money automatically. The very first step on this journey requires us to build a precise architectural understanding of what we are looking for. We must define the anatomy of an economic fortress to dissect the DNA of a true toll bridge business. It's a concept that sounds simple, but its power lies in its strict application. A toll bridge is not merely a strong brand or a profitable company. It is a business that owns a piece of the customer's mind or a piece of the commercial landscape so completely that to not use its service is to accept a significant inconvenience, a higher cost, or a lower quality outcome. The toll is not just money, it can be time, effort, or social standing. To truly grasp this, we must travel back to 1972, to a decision that many of Warren Buffett's partners thought was, at best, a sentimental folly and, at worst, a serious misallocation of capital. It was the purchase of a small regional boxed chocolate company, See's Candies. On the surface, it looked like the antithesis of a toll bridge. It sold a discretionary good, a luxury item. How could a chocolate company be a fortress? But Buffett and his partner Charlie Munger saw something that Wall Street, with its focus on quarterly earnings and industrial might, completely missed. They saw a moat made not of steel and concrete, but of memory and emotion. The story begins with a negotiation. Buffett and Munger were looking to acquire See's Candies from the See family for $25 million. To them, this was a monumental price. It was more than 3 times the company's book value. Berkshire Hathaway at the time was not the behemoth it is today. This was a significant investment. Blue Chip Stamps, a company they controlled, was making the purchase, and their own investment manager Rick Guerin was adamant that the price was too high. He argued, logically, that they shouldn't pay $1 over $20 million. The numbers on the page seemed to support him. See's owned some real estate and had about $8 million in tangible assets. Paying $25 million meant they were paying a $17 million premium for something that didn't physically exist. The brand, the goodwill, the toll. Buffett hesitated. His entire training, inherited from his mentor Benjamin Graham, was based on buying businesses for less than their liquidation value, buying cigar butts with one good puff left in them. Paying a massive premium for an intangible asset was a radical departure, It was Charlie Munger who pushed him across the line. Munger understood that the true asset of See's Candies was its unassailable position in the minds of its customers on the West Coast. He saw that for millions of people, giving a box of See's chocolates for Valentine's Day, for a birthday, for Christmas, was not just a transaction, it was a ritual. It was a signal of quality and affection. To show up with a cheaper, generic box of chocolates was to send a message that you didn't care enough. The customer wasn't just buying chocolate, they were buying the certainty of a positive social outcome. This was the toll. The $17 million goodwill was the capitalized value of that emotional toll bridge. Buffett ultimately agreed, and they paid the $25 million. That decision would change the course of Berkshire Hathaway forever. In the first year, See's generated about $4 million in pre-tax earnings. Decent, but not earth-shattering. But then something magical happened. Every year, after Christmas, the management at See's would suggest a modest price increase. A dime here, a quarter there, and every year the customers paid it without a second thought. Their loyalty was not price-sensitive. The cost of the chocolate was a tiny fraction of the emotional value they received from giving the gift. Over the next few decades, See's Candies would go on to generate over $2 billion in pre-tax earnings for Berkshire Hathaway, all while requiring very little additional capital investment. That $25 million purchase, which seemed so expensive at the time, became one of the greatest investments in history. It was the gusher of cash from See's that funded many of Berkshire's other legendary investments. It was the perfect toll bridge. Low capital requirements, incredible brand loyalty, and most importantly, the power to raise prices year after year without losing business, what Buffett would later call pricing power. The See's Candies story reveals a profound psychological principle at work, one that underpins the most durable brand-based toll bridges: brand loyalty as a cognitive shortcut, combined with the immense power of status quo bias. Our brains are fundamentally lazy. They are designed to conserve energy. We are faced with tens of thousands of decisions every day, from what to wear to what to eat, to which route to take to work. To consciously analyze every single choice would lead to total paralysis. So we create mental shortcuts, or heuristics. A strong brand is one of the most powerful heuristics that exists. When a customer in California in the 1970s needed to buy a gift, they didn't perform a detailed stock analysis of every available confectionery. They didn't compare the cocoa content, the sugar-to-fat ratio, or the efficiency of the supply chains of 10 different chocolate makers. Their brain asked a simpler question: what is the safe, reliable choice that will make the recipient happy and reflect well on me? For millions, the automatic, pre-programmed answer was See's. This isn't a rational decision. It's a subconscious, emotional one. The brand acts as a guarantee of quality, consistency, and social acceptability. Trying a new, unknown brand introduces risk. What if it tastes bad? What if it looks cheap? The cognitive load of evaluating that new option and the emotional risk of getting it wrong is often far greater than the small monetary savings one might achieve. This is the cognitive shortcut in action. It bypasses the logical, price-sensitive part of the brain and goes straight for the emotional core that values safety and predictability. Compounding this is the status quo bias. Humans have a powerful, innate preference for the current state of affairs. Any change from that baseline is perceived as a loss. For a family where giving See's Candies has been a tradition for generations, switching to another brand isn't just a different purchase. It's a break from tradition, a deviation from the norm that feels uncomfortable. The current habit, buying See's, is the default, and overcoming the inertia of that default requires a significant activation energy. A competitor can't just be slightly cheaper or slightly better. They have to be so dramatically superior that they can overcome the powerful psychological gravity of the status quo. In most cases, that's an impossible task. This is why Buffett realized the $17 million premium wasn't for air, it was for a deeply embedded piece of mental real estate in the collective consciousness of his customers. He had purchased a monopoly on the feeling of giving a quality gift of chocolate on the West Coast. This is a far more durable asset than any factory or storefront. So how can we, as retail investors or entrepreneurs, translate this powerful concept into a practical tool for our own decision-making? We need a mental model, a blueprint for identifying these brand-based toll bridges in the wild. Let's call it the brand toll litmus test. It's a series of 4 questions you can apply to any consumer-facing business to gauge the true strength of its economic moat. First is the gift test. Ask yourself, would you be slightly embarrassed to give a cheaper, generic alternative of this product or service as a gift to someone you care about? Think about it. Would you give a friend a Big K Cola instead of a Coca-Cola for their birthday party? Would you take a valued client to a generic motel instead of a Marriott or a Hilton? Would you give your spouse a department store diamond-esque ring instead of one in the iconic Tiffany blue box? If the answer is yes, you would be embarrassed, then you have identified a powerful brand toll. The company is charging a premium not just for the physical product, but for the social insurance that comes with it. The second question is the price increase test. This is the core of Buffett's thesis on pricing power. Ask yourself, if this company raised its prices by 10% tomorrow, would the vast majority of its core customers even notice? And if they did, would they actually go through the hassle of switching to a competitor? For a company like See's Candies, or Apple with its iPhone, or Starbucks with its morning coffee, the answer is a resounding no. The 10% increase is a small price to pay for the consistency, quality, and habit associated with the product. For a commodity business, like a generic gasoline station or a regional airline, a 10% price increase would be a death sentence. Customers would flee instantly. This test separates the true monopolies from the businesses merely pretending to have a strong brand. Third is the holiday rush test. Is there a seasonal, almost ritualistic demand for this product? This question probes the depth of the brand's cultural integration. See's Candies is the classic example, with massive lines out the door for Valentine's Day and Christmas. But it applies elsewhere. Think of TurboTax during tax season. For millions of Americans, the thought of using another software is more stressful than just paying the fee to Intuit. The ritual of using TurboTax is ingrained. This ritualistic demand creates incredible revenue visibility and pricing power during peak periods. And finally, there is the generational test. This is the ultimate test of durability. Do parents actively introduce their children to this brand? Disney is the master of this. Parents who grew up with Disney movies and visiting Disney parks feel a deep-seated need to share that experience with their own children, creating a cycle of loyalty that spans generations. Coca-Cola does it. McDonald's with its Happy Meals does it. When a brand becomes a part of family tradition, it has achieved the highest level of entrenchment. It is no longer just a product. It is a piece of your personal history. A company that passes all 4 of these tests is not just a company. It is a fortress. It is a toll bridge that charges a fee on human emotion, tradition, and our innate desire for cognitive ease. Now, to truly appreciate the genius of this approach, we must dedicate ourselves to understanding its opposite. We must walk the path of the 99%, the path that leads to financial mediocrity and constant struggle. This is the path of the better mousetrap fallacy. The vast majority of investors and entrepreneurs are obsessed with features, technology, and incremental improvements. They believe that success lies in creating a product that is 5% faster, 10% cheaper, or has one extra bell or whistle. They pour their capital and their lives into hyper-competitive industries, a decision that almost guarantees low profitability. Think of the brutal landscape of the consumer electronics industry. Every year, dozens of companies release new televisions, new headphones, new laptops. They fight viciously over screen resolution, processing speed, and battery life. For a brief moment, one company might have a slight edge, a better mousetrap, but within months, their innovation is copied, their price advantage is matched, and they are right back in the bloody red ocean of competition. The margins are razor thin. The capital required for research and development is immense. The brand loyalty is practically non-existent. A customer who buys a Samsung TV one year might happily buy a Sony or an LG the next, based purely on a temporary price drop or a slightly better review. There is no toll bridge here. It's a chaotic multi-lane freeway with no tolls and constant traffic jams. Or consider the restaurant industry. It is the quintessential example of the better mousetrap fallacy. An entrepreneur develops a great new recipe. They open a restaurant. For a while it's popular, but there are virtually no barriers to entry. Another entrepreneur can rent a space across the street, copy the concept with a slight twist, and start competing for the same customers. The fight comes down to price, location, and marketing, all of which erode profitability. The failure rate for restaurants is famously catastrophically high. They are not building toll bridges. They are setting up lemonade stands on a street already crowded with 100 other lemonade stands. The 99% chase these industries because they are exciting, they are visible, they are what the news reports on. But they are wealth traps. The fundamental mistake is confusing a good product with a good business. You can have the best mousetrap in the world, but if anyone can build a similar one and sell it across the street for a penny less, you don't have a business. You have a very difficult, low-paying job. The toll bridge owner, by contrast, might have an old product, a boring product, like chocolate, soda, or railroad transportation. But they own the entire road. The final piece of this puzzle is to connect these abstract principles directly to the numbers, to see how the philosophy of owning a toll bridge manifests on a balance sheet and an income statement. The direct financial connection is all about two words: pricing power, and its glorious downstream effect on gross margins and free cash flow. Let's create a tale of two companies. On one side we have Fortress Chocolates, our stand-in for See's candies. On the other we have Competitive Cacao, a company operating in the hyper-competitive commodity chocolate space, selling to grocery stores under a dozen different private labels. Both companies sell $1 million worth of chocolate in a year. Both face rising costs for their raw ingredients: sugar, cocoa, labor. Let's say their cost of goods sold is $700,000. In year one, both companies have a gross profit of $300,000, or a 30% gross margin. Now, the magic begins. In year two, the management of Fortress Chocolates, confident in their brand's toll bridge, decides to raise prices by 10%. Their total revenue climbs to $1,100,000. Their core customers don't blink. Meanwhile, their input costs rise by a more modest 3% to $721,000. Their gross profit is now $379,000. Their gross margin has expanded from 30% to 34.5%. That extra margin drops directly to the bottom line, increasing net income and, most importantly, free cash flow, the lifeblood of any business. Now look at Competitive Cacao. They are terrified of their competitors. They know that if they raise prices by 10%, their biggest customer, a massive grocery chain, will simply switch to another supplier. They have no pricing power. So they are forced to keep their prices flat at $1 million. But they face the same 3% increase in input costs, so their cost of goods sold also rises to $721,000. Their gross profit shrinks to $279,000. Their gross margin has been compressed from 30% down to 27.9%. They are working just as hard, producing just as much, but making less money. Their ability to invest in the business, to hire better people, to pay dividends, is diminished. This is the great divergence. Over a decade, Fortress Chocolates can repeat this process again and again. Their margins steadily expand. Their profits soar. They become a cash-generating machine that requires little new capital. Competitive Cacao, on the other hand, is in a death spiral. They are constantly forced to cut costs, to squeeze their suppliers, to compromise on quality, just to maintain their shrinking margins. A stock analysis of Fortress Chocolates would show a beautiful, upward-sloping chart of profits and cash flow. A stock analysis of Competitive Cacao would show stagnation and struggle. An investor who understands the toll bridge model doesn't need to predict complex market trends. They just need to find the businesses that have the power to turn inflation from a headwind into a tailwind. This is the ultimate financial advantage. It's how you stop gambling on the market and start owning the mechanisms of wealth creation itself. This is the foundational pillar of the entire philosophy. Once we have mastered the art of identifying a basic toll bridge, we must turn our attention to the modern era, to the digital landscape, where the most powerful moats are no longer built of brand alone but of code and connectivity. This brings us to our second pillar, the network effect, the bridge that builds itself. A business with a network effect becomes more valuable to every user as more users join the system. This creates a powerful, self-reinforcing feedback loop. The first person to own a telephone had a useless device. The second person made the first telephone exponentially more valuable. With 1 billion users, the network becomes an indispensable utility of modern life. Owning the dominant network is like owning all the bridges, all the roads, and all the ports in a country simultaneously. To truly understand the breathtaking power of this concept, we must once again turn to a story from Buffett's career, a moment of crisis that revealed the true nature of a network-based fortress. The year was 1963, and a major financial disaster known as the Salad Oil Scandal was unfolding. A company called Allied Crude Vegetable Oil, run by a man named Tino De Angelis, had perpetrated a massive fraud. They were borrowing huge sums of money against their inventory of salad oil, which was stored in giant tanks in New Jersey. The problem was, the tanks were mostly filled with water, with only a thin layer of oil on top. When the fraud was discovered, the company collapsed, and its creditors, including many major Wall Street banks, faced catastrophic losses. One of those creditors was American Express. Amex, through its warehousing division, had issued receipts for the salad oil, receipts that were now worthless. The market panicked. The perception was that American Express would be on the hook for all the losses, a sum so vast it could bankrupt the company. The stock price plummeted by nearly 50%. The consensus on Wall Street was to sell, to get out before the company went to zero. This was a moment of maximum fear and uncertainty. It was in this chaotic environment that a young Warren Buffett saw not a liability, but an immense, misunderstood asset. He didn't focus on the warehouse receipts or the potential legal damages. He focused on the real business of American Express, the traveler's checks and the charge cards. He understood that the company's value wasn't on its balance sheet. It was in the network it had built. The network consisted of two sides. Millions of cardholders who used the Amex card for convenience and prestige, and hundreds of thousands of merchants, restaurants, hotels, airlines, who accepted the card because so many high-spending customers carried it. This was a classic two-sided network. The more cardholders there were, the more essential it became for merchants to accept the card. The more merchants who accepted the card, the more useful it became for cardholders. Buffett's core question was simple. Had the salad oil scandal damaged this network? Did people stop using their cards because of a fraud in an obscure warehousing division? To find the answer, he didn't rely on Wall Street reports. He engaged in what he called scuttlebutt investing. He went out and did the legwork himself. He visited restaurants and hotels. He talked to cashiers. He asked them if they were seeing fewer customers using American Express cards or traveler's checks. The answer was a universal no. The customers didn't care about salad oil. They cared about the convenience and status of the green card. He even went to his local Omaha bank and observed customers buying traveler's checks. He saw that their behavior hadn't changed one bit. The network was intact. The scandal had created a massive divergence between the price of the company's stock and the intrinsic value of its business. Buffett realized the market was pricing in a fatal wound, when in reality, the company had merely suffered a flesh wound that had nothing to do with its core, incredibly powerful network moat. He invested 40% of his partnership's capital into American Express stock, a massively concentrated bet. Over the next few years, the company settled the legal claims for a fraction of what the market had feared, and the underlying business continued its relentless growth. The stock soared, and Buffett's partners made a fortune, he had recognized that the true toll bridge was the ecosystem of trust and utility between cardholders and merchants. The scandal was just a temporary distraction, a cloud passing in front of an eternal sun. The American Express story beautifully illustrates the psychological engine behind network effects, a potent combination of social proof and the fear of missing out, FOMO. Humans are social creatures. We look to others for cues on how to behave, especially in situations of uncertainty. This is social proof. When we are choosing a social media platform, a payment app, or an online marketplace, we are heavily influenced by which platforms our friends, family, and colleagues are using. Joining a network with billions of users like Facebook or Visa feels like a safe, smart decision. The network's size is a powerful signal of its value and stability. Conversely, joining a new, unproven network with few users feels risky. What if it fails? What if it's a waste of time? This creates a formidable barrier to entry for any potential competitor. They aren't just competing on features, they are competing against the powerful psychological comfort of the established crowd. This dynamic is often described by Metcalfe's law, which states that the value of a telecommunications network is proportional to the square of the number of connected users of the system. In simpler terms, adding a new user doesn't just add one unit of value, it adds value to all existing users by creating new potential connections. This creates a non-linear, explosive growth in the network's utility as it scales. Then comes FOMO. As a network grows, it reaches a tipping point where not being a part of it becomes a disadvantage. If all your friends are organizing events on Facebook, you miss out on your social life by not having an account. If all the job opportunities in your industry are being posted on LinkedIn, you are at a career disadvantage by not being on the platform. If you want to sell your used furniture, you know that posting it on Craigslist or Facebook Marketplace will reach the largest possible audience of buyers. Choosing not to use the dominant network means accepting a worse outcome. At this point, the network transforms from a nice-to-have to a must-have. The toll is no longer optional. You must pay it, with your data, your attention, or transaction fees, to fully participate in modern society or commerce. This powerful psychological pincer movement, the pull of social proof and the push of FOMO, is what allows a network effect business to build a bridge that literally grows wider and stronger with every person who crosses it. How can we, as discerning investors, systematically identify businesses with these powerful, self-reinforcing moats? We need a framework, a mental model to cut through the hype and analyze the underlying structure of a potential network. Let's call it the empty restaurant test. Imagine you walk past two restaurants side by side. One is bustling with happy diners, a line out the door. The other is completely empty. Which one do you instinctively assume has better food? The full one, of course. That's social proof in action. We use the same logic to evaluate network businesses. The test has 4 parts. First, you must identify the nodes. A network is made of participants or nodes. Who are they? Sometimes it's a single group, like users of a messaging app like WhatsApp. The value comes from connecting with other users. More often, it's a two-sided market. For eBay, it's buyers and sellers. For Uber, it's riders and drivers. For the Apple App Store, it's users and developers. You must clearly define who the participants are to understand the dynamics of the network. Second, you must analyze the value proposition. Crucially, does the value for each new user increase as more users join? For a network like Visa, the answer is a definitive yes. Every new merchant that accepts Visa makes the card more valuable for every cardholder, and every new cardholder makes accepting Visa more valuable for every merchant. But be careful, some businesses look like networks but aren't. A gym franchise, for example, might have many locations, but a new member in California does not increase the value of the gym for a member in New York. That's a scaled business, not a network effect business. Third, you must assess the switching costs. How difficult or painful is it for a user to leave the network and join a competitor? For a social network like Facebook or Instagram, the switching costs are immense. You would lose years of photos, friend connections, and messages, your entire digital history. For an operating system like Microsoft Windows, the switching costs involve relearning all new software and ensuring compatibility with your existing files. High switching costs act as the anchor chains, locking users into the ecosystem and making the toll bridge inescapable. And fourth, you must look for the cold start problem. This is the ultimate test. Every network starts with 0 users, the digital equivalent of the empty restaurant. How did the company solve this catch-22? How did they get the first riders for Uber when there were no drivers, or the first sellers on eBay when there were no buyers? Successful companies have clever strategies to solve this. PayPal famously paid people $10 to sign up. Facebook started by exclusively targeting the dense, interconnected network of Harvard students. A company that has successfully navigated the cold start problem has proven the potency of its value proposition and the soundness of its strategy. By applying this 4-part test, you can distinguish between true, durable network moats and the fleeting popularity of a hot new app. To fully grasp the power of owning the network, we must again explore the antithesis, the path of the 99% of tech entrepreneurs and venture capitalists. This is the graveyard of the ghost town platform. The history of technology is littered with the corpses of beautifully designed, technologically sound platforms that failed to ignite a network effect. They built the restaurant, but nobody came. The most famous example is Google+. In 2011, Google, one of the most powerful and resource-rich companies on the planet, launched its own social network to compete with Facebook. On paper, it had every advantage. It had a brilliant engineering team, a massive budget, and seamless integration with other Google products like Gmail and Search. It had features that were in many ways superior to Facebook's, like Circles for organizing friends. But it failed. It failed spectacularly. Why? Because it could not solve the cold start problem in the face of an entrenched incumbent. People's digital lives, their friends, their photos, their social history, were already on Facebook. To join Google+, they would have to rebuild that entire social graph from scratch. The switching costs were too high. The value of joining a new, empty network was 0, even if the technology was slick. Google+ became a digital ghost town. People created accounts, looked around, saw that none of their friends were active, and left, never to return. The 99% of investors get seduced by the story of the Facebook killer. They invest in a new platform because it has a cool feature or a charismatic founder. They fail to understand that they are not investing in a piece of technology. They are investing in a community. And breaking the gravity of an established community is one of the hardest things to do in business. Countless venture capital funds have been incinerated, funding marketplaces that couldn't attract a critical mass of buyers and sellers, or social apps that couldn't build a community. They all make the same mistake. They focus on building the bridge, but they have no plan to get people to cross it. The owner of the dominant network doesn't have to have the absolute best technology. They just have to have everybody else. The financial manifestation of a powerful network effect is one of the most beautiful things to behold in business. It shows up in 2 key metrics: customer acquisition cost, lifetime value, LTV. For a normal business, acquiring a new customer is expensive. They have to spend money on advertising, marketing, and sales teams. Let's say a typical company spends $100 to acquire a new customer. Now, for a business with a burgeoning network effect, something magical happens. As the network grows, it becomes its own marketing engine. New users join not because they saw an ad, but because their friends invited them, or because it has become the industry standard. The network itself generates new users organically. This causes the company's average customer acquisition cost to decline over time, even as it scales. It costs Facebook or Google virtually nothing to acquire their next user. Now let's look at the other side of the equation: lifetime value. Because of the high switching costs and the increasing utility of the network, customers tend to stick around for a very long time and become more deeply embedded in the ecosystem. An Apple user who starts with an iPhone might then buy a Mac, an Apple Watch, and subscribe to iCloud and Apple Music. Their LTV grows and grows. The holy grail for any business is a high and rising ratio of LTV to CAC. For a dominant network effect business, this ratio can become astronomical. They spend less and less to acquire customers who become more and more valuable over time. This is what allows for the incredible profitability and scalability of companies like Microsoft, Google, and Visa. When you do a stock analysis, you can see this in their financial statements. They exhibit what is called operating leverage. As their revenues grow, their costs, especially sales and marketing, grow at a much slower rate. This causes their operating margins to expand relentlessly. This is the direct financial signature of a toll bridge that builds itself. It allows for massive portfolio growth because these companies can grow their profits exponentially without needing to pour proportional amounts of new capital into the business. They have achieved the business nirvana of scalable, high-margin growth, all powered by the psychological forces of human connection. We have explored moats built from brands and moats built from networks. Now we turn to a third and perhaps the most formidable type of toll bridge, the regulatory moat, the government-granted toll. In this model, a company's greatest competitive advantage is not its product or its customers, but its relationship with the government. Through licenses, patents, or entrenched regulations, the government effectively outlaws competition, handing a company or a small group of companies a legal monopoly or oligopoly. To be in business with a government that has a printing press is a very good position to be in. Owning a company with a regulatory moat is like owning a bridge that the king himself has declared is the only legal crossing point in the realm. The story that perfectly captures the power of this type of moat is Buffett's long-standing investment in Moody's Corporation, the credit rating agency. To the average person, Moody's is an obscure financial services company. To Buffett, it was one of the most perfect business models ever created. Its origins as a fortress date back to the aftermath of the Great Depression. In the wake of massive bond defaults, the government created a host of new financial regulations designed to protect investors. One of these sets of rules, established by bodies like the Office of the Comptroller of the Currency, effectively required that many institutional investors, like banks and pension funds, could only hold bonds that had been deemed investment grade by a, quote, nationally recognized statistical rating organization, or NRSRO. Who were these organizations? The government didn't create its own, it simply anointed the existing players, primarily Moody's and Standard & Poor's. In an instant, a government mandate created a powerful duopoly. If a corporation or a municipality wanted to raise money by selling bonds in the public market, they now times to go to Moody's or S&P and pay them a fee to get a rating. Without that rating, a huge portion of the investment world was legally barred from buying their debt. The demand for their service became inelastic and legislatively guaranteed. They were not selling a service that was merely desired. They were selling a ticket that was required to enter the arena of capital markets. Buffett began investing in Moody's after it was spun off from its parent company, Dun & Bradstreet, in 2000. He saw a business that was almost too good to be true. It had immense pricing power. If Moody's decided to raise the fee for rating a bond, what was the issuer going to do? Go to a startup rating agency that nobody had heard of, and that didn't have the government's seal of approval? Of course not. They paid the toll. Furthermore, the business required almost no tangible capital. Moody's didn't need factories or expensive machinery. Its primary assets were its brand, its historical data, and its government-sanctioned status. Analysts would sit at desks, analyze financial statements, and pronounce a rating. This resulted in incredible profit margins and returns on capital. For years, Moody's generated operating margins north of 40% and 50%. It was a cash-generating machine. Even after the 2008 financial crisis, where the rating agencies were heavily criticized for giving AAA ratings to garbage mortgage-backed securities, Their fundamental business model remained intact. The government scolded them, fined them, but ultimately re-entrenched their position because the entire financial system was built around their ratings. There was no viable alternative. The regulatory moat was so deep and so wide that even a massive crisis couldn't breach it. Buffett understood that the company's real asset was not its analytical prowess, but its entrenched position in the plumbing of the financial system, a position protected and reinforced by the United States government. He was not just buying a company, he was buying a piece of the regulatory infrastructure of modern finance. The psychological principle that makes regulatory moats so effective is a powerful one-two punch of authority bias and complexity aversion. Humans are wired to obey and trust figures of authority. A person in a lab coat, a police officer in a uniform, a judge in a robe, these symbols trigger a subconscious deference. In the world of finance, government regulation acts as the ultimate symbol of authority. When the government sanctions an entity like Moody's as an official arbiter of credit quality, it cloaks the company in an aura of legitimacy and power. Fund managers, corporate boards, and individual investors are heavily influenced by this. To go against an official rating is to take on significant career and legal risk. If a pension fund manager buys a bond that Moody's rated AAA and it defaults, they can say, "I followed the official guidance." But if they buy an unrated bond that defaults, they could be sued for negligence. The authority bias creates a powerful incentive to comply and pay the toll. Compounding this is complexity aversion. The world of corporate bonds and structured financial products is mind-numbingly complex. Analyzing the covenant structure of a multi-billion-dollar bond issuance is beyond the capability of most people. The credit ratings, AAA, AA, B, CCC, serve as a brilliant cognitive shortcut. They distill thousands of pages of complex information into a single, simple letter grade. This simplification is immensely appealing to the human brain, which, as we know, seeks to avoid difficult mental work. An investor doesn't need to understand the details, they just need to know if it's investment grade. This aversion to complexity makes the service provided by the rating agencies incredibly sticky. They are selling clarity and peace of mind in a world of overwhelming complexity. The combination is potent. The government's authority makes you feel you must use the service, and the service's simplicity makes you want to use it. This creates a psychological lock on the customer that is nearly impossible for a new competitor to break. So how can we systematically hunt for these government-granted toll bridges? We need a practical framework for spotting them. Let's call it the gatekeeper framework. It involves looking for companies that control a mandatory checkpoint in a commercial process. There are 3 key steps. First, you must follow the paper trail. This involves looking for industries where government licenses, patents, or specific approvals are essential to operate. Think about waste management. To operate a landfill, a company like Waste Management, Inc. needs a mountain of environmental permits and local government approvals, creating enormous barriers to entry. Think about pharmaceuticals. A company like Pfizer or Merck is granted a patent, which is a government-enforced monopoly on a new drug for a set period, allowing them to charge very high prices. Think about utilities or airport operators. They are often granted explicit monopolies over a specific geographic area. Start by looking for industries where the phrase regulatory approval is a constant feature of the business landscape. Second, you must identify the required step. Within these regulated industries, what is the one thing a company must do or buy to participate? Is there a company that provides that indispensable step? For example, in the aviation industry, every aircraft engine needs to be serviced and certified by an approved provider. Companies that dominate this highly regulated niche, like divisions of General Electric or Rolls-Royce, have a powerful moat. In the world of medical devices, a company that produces a patented, FDA-approved surgical tool that becomes the standard of care has a gatekeeper position. You are looking for the company that sells the key that everyone else needs to open the door. Third, and most critically, You must analyze the durability of the regulation. This is what separates a true fortress from a temporary windfall. Is the regulation based on a long-standing law rooted in public safety or systemic financial stability? Or is it a temporary political creation, like a specific tax credit or subsidy, that could be eliminated in the next election cycle? The best regulatory moats are built on decades-old, bipartisan, and deeply entrenched rules that are incredibly difficult to change. The rules governing the financial rating agencies, the FDA's drug approval process, or the FAA's aerospace safety standards are examples of durable moats. An investor who chases a company whose entire business model depends on a temporary solar panel subsidy is not buying a toll bridge. They are gambling on the whims of politicians. True wealth management is about finding the permanent, not the temporary, advantage. To fully appreciate the stability of a regulatory moat, we must examine its antithesis, the perilous path of chasing the deregulation boom or the subsidy play. The 99% of investors are frequently lured in by exciting headlines about new government initiatives or the promise of a newly deregulated market. This is often a trap. Consider the boom and bust cycles in the alternative energy sector. A government announces a generous new tax credit for solar panel installations. Suddenly, dozens of solar companies pop up. Their stocks soar as investors pile in, chasing the government-fueled gold rush. But this moat is made of sand. A few years later, a new administration takes over, the political winds shift, and the tax credit is reduced or eliminated. The artificial demand evaporates overnight. The solar companies, who have no real pricing power and are entirely dependent on the subsidy, enter into a brutal price war to survive. Most go bankrupt. The investors who chase the headline are wiped out. The same danger exists in deregulation. A government announces it is deregulating the airline or telecommunications industry. The promise is that new, innovative companies can now enter and compete. Investors get excited about the growth potential. But what deregulation often means is the destruction of old moats without the creation of new ones. The once stable, regulated monopolies are now thrown into a hyper-competitive environment. The result is rarely a paradise of innovation and profitability. More often, it's a brutal price war that drives down returns for everyone in the industry. The retail investor who gets excited by the story of deregulation fails to ask the most important question: where is the new, durable, competitive advantage going to come from? If the answer is simply "we will be cheaper," that is not a moat. That is a recipe for long-term value destruction. The intelligent investor understands that the government's power to give is matched only by its power to take away. True long-term investing is about finding businesses whose success is insulated from, not dependent on, the shifting tides of politics. The financial signature of a powerful regulatory moat is one of beautiful predictability and capital efficiency. It manifests directly on the financial statements through two key characteristics: revenue visibility and low capital expenditures. A company with a government-granted toll, like our Moody's example, has incredibly high revenue visibility. They can predict with a high degree of certainty how much revenue they will generate next year and the year after. Their customers are locked in by law or regulation. They have to come back. This is the opposite of a cyclical business, like a car manufacturer, whose sales can swing wildly based on the health of the economy. This predictable, recurring revenue stream is highly prized by the market and leads to a more stable stock price and a more reliable stream of dividends. It is a cornerstone of any sound asset allocation strategy. Furthermore, many of these businesses, particularly those based on patents or official designations, have very low capital expenditure requirements. As we noted, Moody's doesn't need to build billion-dollar factories. A pharmaceutical company, once it has covered its initial research and development costs, can produce its patented pill for pennies and sell it for dollars. This combination of highly predictable revenue and low capital needs creates a torrent of free cash flow. This is the ultimate goal of any business. Free cash flow is the money left over after all expenses and investments have been paid. It can be used to pay dividends to shareholders, buy back stock, increasing the value of the remaining shares, or acquire other businesses. A company that gushes free cash flow year after year is a compounding machine, a direct engine for achieving financial freedom for its owners. When you analyze a company's financial statements, look for a consistent history of high and stable profit margins combined with low capital expenditures as a percentage of sales. That is the mathematical fingerprint of a government-granted toll bridge. We now arrive at the fourth pillar, the most tangible and intuitive form of competitive advantage, the unique asset, the irreplaceable bridge. This is a business whose moat is derived from a physical or intangible asset that is either economically unfeasible or literally impossible for a competitor to replicate. This could be a strategic location, a proprietary natural resource, or a critical piece of infrastructure. While brand and network moats are powerful, they can be subject to shifts in taste or technology. A unique, hard asset provides a defense that is brutally simple and enduring. To own such an asset is to own a piece of economic reality that no one else can touch. The quintessential example of this in Warren Buffett's portfolio, and perhaps the greatest physical toll bridge in the modern world, is the Burlington Northern Santa Fe BNSF Railway. In 2009, in the midst of the global financial crisis, Buffett made the biggest bet of his career, acquiring the entirety of BNSF for $44 billion. He called it an all-in wager on the economic future of the United States. To many, buying a 19th-century technology like a railroad seemed like a step backward. But Buffett saw the ultimate, irreplaceable asset. Think about what a railroad like BNSF actually is. It's a 500-mile network of steel track that connects the major economic centers of the western United States. It is a circulatory system for the American economy, moving essential goods like grain from the Midwest, coal from Wyoming, and containers from the ports of Los Angeles and Long Beach. Now ask yourself the critical question: could you build another one? The answer is an unequivocal no. The sheer cost would be in the trillions of dollars. But more importantly, it would be physically impossible. You would have to acquire a continuous strip of land stretching from Chicago to California, cutting through farms, cities, and national parks. You would have to blast new tunnels through the Rocky Mountains. The environmental regulations, the property rights battles, the not-in-my-backyard protests. It is a complete non-starter. BNSF, along with its main competitor Union Pacific, has a duopoly on long-haul land transportation of bulk goods in the western U.S. that is more secure than any patent or brand. If you are a farmer in North Dakota who needs to ship 1 million bushels of wheat to the port to be exported to Asia, you can't use a truck. It would be absurdly expensive. You have to use the railroad. You have to pay the toll to BNSF. Buffett understood that he wasn't just buying tracks and locomotives. He was buying a permanent and essential piece of the American economic landscape. He was buying a toll bridge made of 500 miles of steel. The underlying psychological principle that makes a unique asset so valuable is the scarcity heuristic. Our brains are programmed to place a higher value on things that are rare, limited, or difficult to obtain. This is an evolutionary trait. In a world of limited resources, securing something scarce meant a higher chance of survival. This deep-seated bias powerfully influences our perception of economic value. An irreplaceable asset like the BNSF Railroad is the ultimate embodiment of scarcity. There are only a handful of major railroads in North America, and no more are being built. This physical limitation creates a perception of immense and permanent value in the minds of both customers and investors. Customers know they have limited alternatives, which gives the railroad pricing power. Investors know that no new competitor is going to suddenly appear and disrupt the business model. This contrasts sharply with industries where assets are easily replicable. Anyone with enough capital can build a new hotel, a new factory, or a new software application. The supply is potentially unlimited, which keeps a lid on the long-term profitability of any single asset. The scarcity of major railroad networks, prime real estate locations or unique mineral deposits creates a psychological foundation of value that is incredibly stable. We instinctively understand that you cannot just make more of it. This perception of scarcity allows the owner of the asset to command a premium price and earn outsized returns for decades, insulated from the creative destruction that roils most other industries. It's a bet on the simple, powerful, and unchanging laws of physical supply and demand. To apply this principle, we need a mental model for identifying businesses built around these irreplaceable assets. Let's call it the replication cost analysis. It's a thought experiment designed to test the true durability of a company's physical or intangible moat. It consists of 3 stages. First, you must calculate the impossible price. Start by trying to estimate, in rough terms, what it would cost in today's dollars to perfectly replicate the company's key asset from scratch. For BNSF, as we discussed, the cost is effectively infinite. Let's take another example, the Coca-Cola Company. Its key asset isn't its secret formula, which competitors have come close to replicating. Its key asset is its global distribution network and its brand. What would it cost to build a bottling and distribution system that reaches every remote village on Earth, and to spend a century and trillions of dollars in advertising to build a brand as universally recognized as Coke? Again, the price is so astronomical as to be effectively impossible for a new entrant. If the replication cost of the core asset is orders of magnitude higher than the company's current market valuation, you have likely found a powerful moat. Second, you must identify the choke point. Does the unique asset control a critical, narrow point in a broader value chain? A single pipeline that carries the majority of oil from a major production field to a refinery is a classic choke point. A port that serves as the only deepwater entry point for an entire geographic region is another. The company that owns the choke point can extract a toll from all the commerce that must flow through it. You are looking for a business that owns a bridge, not just a boat. Third, you must assess the not in my backyard NIMBY factor. This is a powerful modern barrier to replication. Ask yourself, even if a competitor had unlimited money, would society allow them to build a similar asset today? Could you get the permits to build a new landfill near a major city? A new quarry? A new airport? In most developed countries, the answer is a firm no. Public opposition and environmental regulations make the creation of new, large-scale infrastructure projects incredibly difficult. This means that the owners of the existing, grandfathered-in assets have a moat that is constantly being deepened and reinforced by societal and political trends. Companies in industries like waste management, aggregates, and certain types of infrastructure benefit enormously from the NIMBY factor. To truly value the fortress of a unique asset, we must again visit the wasteland of its opposite, the commodity trap. The 99% of investors consistently make the mistake of investing in businesses whose assets are fungible and easily replicable commodities. They are drawn to the seeming simplicity of these businesses, but they fail to see the brutal economics that lie beneath the surface. Think of a generic oil and gas exploration company. It may have a successful year and discover a new oil field, but its core asset, the oil in the ground, is a commodity. Its price is set by global markets, completely outside the company's control. And there is nothing to stop a competitor from drilling another well next door and producing the exact same product. The companies are in a constant race on a technological treadmill, needing to find new reserves just to replace the ones they are depleting. There is no lasting competitive advantage, only a relentless cycle of boom and bust. Or consider a simple manufacturing business with no proprietary technology. Anyone with capital can buy the same machines, lease a similar factory, and produce a nearly identical product. The competition inevitably comes down to who can pay their workers the least and sell their product for the lowest price. It is a race to the bottom. Even in the tech world, a software company whose code is not protected by patents or deep network effects is in a commodity business. A determined team of developers can replicate their functionality in a matter of months. These businesses may have periods of profitability, but their capital gains are fleeting and subject to the brutal forces of competition and cyclicality. They are the definition of anti-toll bridges. They own nothing unique. They control no choke points. They are simply one of many participants in a crowded, bloody arena. This is the path to mediocre returns and a portfolio that is constantly at the mercy of forces beyond its control. It is the antithesis of the durable, long-term investing strategy we seek. The direct financial connection for a business with a unique asset is found in two powerful concepts: high barriers to entry and superior return on tangible assets. The enormous, often infinite, replication cost of the asset creates the ultimate barrier to entry. This is the wall that keeps competitors out and allows the incumbent company to earn outsized profits for decades. Unlike a brand, which must be constantly nurtured with advertising, or a technology, which must be constantly updated, a well-maintained physical asset provides a defense that is largely permanent and passive. This structural advantage flows directly to the financial statements. When analyzing such a company, you should pay close attention to its return on assets, ROA, and specifically, its return on tangible assets. This metric tells you how efficiently the company is generating profits from its physical base, its property, plant, and equipment, PP&E. A company like BNSF invests billions every year to maintain and upgrade its track and locomotives. But each dollar invested goes towards strengthening a fortress that no one else can build. This allows them to earn a stable and attractive return on that massive asset base, year after year. Contrast this with a company in a competitive commodity industry, like an airline. An airline also has a lot of tangible assets, its airplanes. But these assets provide no real moat. Any competitor can lease or buy the same Boeing or Airbus jets. The result is that the airline industry as a whole has historically earned a very low return on its invested capital. The assets do not create a durable advantage. They are simply the ticket required to enter the brutal competition. By focusing on businesses where the tangible assets themselves form the moat, you can identify companies capable of generating superior protected returns over the very long term. This is how you build a portfolio of solid, reliable engines of portfolio growth, rather than a collection of speculative ventures. We have now explored the four major types of toll bridges: the brand, the network, the regulation, and the unique asset. But finding the bridge is only half the battle. Owning it successfully requires a specific temperament, a psychological fortitude that is perhaps the rarest asset of all. This brings us to our fifth and final pillar, the toll collector's mindset. It is a philosophy of patience, price discipline, and the strategic use of permanent capital. It's not enough to identify a great business. You must buy it at a sensible price and have the emotional resilience to hold it for the long term, allowing the magic of compounding to do its work. The perfect anecdote to illustrate this mindset is Buffett's seminal investment in the Coca-Cola Company in 1988. This was not just another stock purchase. It was a profound philosophical statement. The context is crucial. The investment was made in the aftermath of the infamous Black Monday stock market crash of October 1987, when the market plummeted in a single day. Fear was rampant. The consensus was that the bull market was over and a new depression was imminent. Investors were dumping stocks indiscriminately, desperate to get to the perceived safety of cash. In this environment of pure panic, what was Warren Buffett doing? He wasn't watching the stock ticker. He wasn't listening to the talking heads on television. He was sitting in his office, calmly reading 50 years of Coca-Cola's annual reports. He was tuning out the market's manic depressive noise and focusing on the business's permanent, unchanging reality. What he saw was the ultimate toll bridge. It was a simple, easy-to-understand product. It had arguably the most powerful brand in human history, an intangible asset of incalculable value. It had a global distribution system that was a unique, virtually irreplaceable asset. And most importantly, he saw a massive runway for growth. He studied per capita consumption figures from around the world and realized that while the average American drank hundreds of servings of Coke a year in many large developing countries, the figure was in the single digits. The potential was enormous. Buffett performed a detailed analysis, not of the stock's chart pattern, but of the business's intrinsic value. He calculated what a rational private buyer would pay for the entire company, based on its future cash-generating potential. He concluded that the business was worth far more than its stock market price, which had been beaten down by the general market panic. The market was focused on the short-term fear of a recession. Buffett was focused on the long-term reality of billions of people wanting a simple, enjoyable moment of refreshment. Between 1988 and 1989, Berkshire Hathaway invested over $1 billion to acquire a 6.2% stake in Coca-Cola. It was a massive, concentrated position. Many observers were skeptical. They saw Coke as a mature, boring company. But Buffett wasn't buying a story, he was buying a business. And then, he did the most important thing: nothing. He held the stock. He held it through recessions, through market jitters, through the new Coke fiasco. He understood that the day-to-day fluctuations of the stock price were irrelevant. What mattered was that every day, billions of people around the world were paying a tiny toll to his company for a moment of happiness. That $1 billion investment through stock splits and reinvested dividends has grown to be worth tens of billions of dollars today. It is a masterclass in the toll collector's mindset. Use market fear to buy a wonderful business at a fair price, and then have the patience to let the business work its magic for you over decades. The psychological demons that the toll collector's mindset must conquer are myopic loss aversion and time inconsistency. These are two of the most powerful and destructive cognitive biases in investing. Myopic loss aversion, a concept identified by behavioral economists Daniel Kahneman and Amos Tversky, describes the fact that humans feel the pain of a loss roughly twice as powerfully as they feel the pleasure of an equivalent gain. This is magnified by a short-sighted, myopic view. If you check your stock portfolio every day, you will be exposed to the random, painful daily drops far more frequently, even if the long-term trend is upward. This constant exposure to small losses triggers our powerful loss aversion instinct, leading to panic selling at the worst possible time. An investor who sells a great company like Coca-Cola during a market crash because they can't stand the short-term paper loss is a victim of myopic loss aversion. The second demon is time inconsistency, also known as hyperbolic discounting. This is our tendency to prefer smaller, immediate rewards over larger, delayed rewards. We would rather have one marshmallow today than 2 marshmallows tomorrow. In investing, this manifests as an obsession with short-term profits. An investor buys a great toll bridge stock. It goes up 20% in 6 months. The temptation to sell and lock in the gain is immense. It provides an immediate hit of gratification, but in doing so, they forego the chance to earn a 1,000% or 10,000% gain over the next 20 years. They are trading a life-changing fortune for a small, quick thrill. Buffett's entire philosophy is an inversion of these biases. He thinks in terms of decades, not days. This long-term perspective dampens the pain of short-term volatility. He is willing to endure years of underperformance if he believes in the long-term value of the business. And he completely rejects the lure of the quick profit, understanding that the real money is made by letting the compounding machine run uninterrupted for as long as possible. He has trained his brain to take the 2 marshmallows tomorrow, every single time. To cultivate this mindset, we need a practical checklist, a set of rules to govern our own executive decision-making. Let's call it the Buy and Hold Forever checklist. It is the final blueprint for acting like a true toll collector. First is the 10-year test. Before you buy a single share of a company, ask yourself, can I confidently predict, in broad strokes, what this business will look like and how it will make money in 10 or 20 years? Will people still be drinking Coke, using Google for search, needing to ship goods by rail? For a true toll bridge, the answer is usually a simple yes. For a speculative biotech company or a trendy tech startup, the answer is far more uncertain. This test filters for businesses with durable, understandable competitive advantages and avoids the fleeting and complex. Second is the price versus value calculation. This is the cornerstone of intelligent investing. Never ask, is the stock going to go up? Instead, ask, what is the business worth, and am I paying less than that? You must separate the fluctuating price of the stock from the underlying intrinsic value of the business. You don't need a precise number, but you need a conservative range. The goal is to follow Buffett's famous maxim: it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Market downturns are not crises. They are opportunities to buy wonderful companies on sale. Third, and most difficult, is the do-nothing default. Once you have purchased a piece of a high-quality toll bridge at a sensible price, your default action should be to do absolutely nothing. Resist the siren song of the financial media, which is designed to provoke action in trading. Resist the urge to constantly check your portfolio. Your job is not to be an active trader. Your job is to be a passive owner. Let the management of the company collect the tolls, and let the power of compounding work its silent, inexorable magic. True wealth management is often about what you don't do. The antithesis of this patient, disciplined approach is the frenetic and ultimately self-defeating world of the active trader illusion. The 99% of market participants are conditioned to believe that success in investing is correlated with activity. They watch financial news channels where pundits are constantly shouting buy or sell. They use trading apps that have been gamified with confetti and celebratory sounds to encourage frequent transactions. They chase hot story stocks based on a tip from a friend or an article they read online. They believe that to be a serious investor, one must be constantly analyzing charts, setting stop losses, and moving in and out of positions. This entire ecosystem is a massive illusion. It is designed not to make the investor wealthy, but to enrich the brokers who collect commissions, the market makers who profit from the bid-ask spread, and the financial media that sells advertising by creating a constant sense of urgency and excitement. The active trader is not a toll collector. They are the one constantly paying tolls. They pay tolls in the form of trading fees. They pay tolls in the form of capital gains taxes every time they sell a winner. And they pay the biggest toll of all in the form of bad timing, inevitably buying high in a frenzy of greed and selling low in a fit of panic. This path is a surefire recipe for mediocre returns and a failure to ever achieve true financial freedom. It is the hamster wheel of the market, a lot of motion that ultimately leads nowhere. The toll collector calmly steps off the wheel and buys the entire cage. The direct financial connection, the ultimate mathematical proof of the toll collector's mindset, lies in two of the most powerful forces in the universe: the power of compounding and the immense benefit of tax deferral. By buying and holding a great toll bridge business, you allow your returns to compound on themselves, uninterrupted. Let's use a simple illustration. Imagine you invest $10,000 in a great company that grows at an average of 15% per year. If you simply buy and hold, after 30 years, that initial investment will have grown to over $662,000. Now let's imagine an active trader who achieves the same 15% annual return, but they do it by trading in and out of stocks, selling their winners at the end of each year. Each time they sell, they have to pay capital gains tax on their profits. Let's assume a modest 20% tax rate. That tax acts as a constant drag, a leak in the compounding engine. After 30 years of earning 15% but paying taxes annually, their $10,000 will have grown to only about $280,000. That's a difference of over $380,000. It is a fortune lost, not to bad stock picking, but to a bad strategy. By simply holding on, the patient toll collector allows their capital to grow in a tax-deferred environment, only paying the tax once, far in the future, if they ever sell at all. This is not a small detail. It is the fundamental arithmetic of wealth. The combination of owning a high-return, cash-gushing toll bridge business and letting those returns compound for decades without the friction of taxes and trading costs is the most reliable, time-tested path to extraordinary wealth ever devised. It is the final promise of this entire philosophy. It is the ultimate financial transformation. You have just invested a significant amount of your time and attention, and for that, you have acquired a powerful and complete mental tool. You now possess the toll bridge framework, the ability to see the hidden economic moats that protect the world's greatest businesses. You understand how to identify the fortresses of brand, the self-building bridges of network effects, the government-granted monopolies of regulation, and the irreplaceable choke points of unique assets. You have armed yourself with the mindset of the toll collector, ready to deploy patience and discipline. This is a profound advantage that separates you from the 99% of market participants who are still fighting in the hyper-competitive arena. But understanding the map of these fortresses is only the first part of the campaign. A map is useless if you don't know how to read the terrain, how to know when the price of entry is a bargain or a king's ransom. The toll bridge model tells you what bari to buy, but the equally critical, interconnected science evaluation tells you hundreded when and at asterisk what price to buy it. Finding a wonderful business is one thing. Buying it at a price that offers a margin of safety and the potential for extraordinary returns is a completely different, yet essential, discipline. It is the link that connects identifying a great asset to actually profiting from it. The video that is now on your screen is the next piece of this intellectual arsenal. It is the key to that valuation vault. Think of what you've just learned as the powerful engine of a race car. The next video is the steering wheel, the braking system, and the GPS. It provides the control and precision needed to navigate the market and arrive at your destination of financial freedom. The choice to click is not about watching another video. It is a conscious decision to continue your ascent. It is a declaration that you are committed to becoming not just a stock picker, but a complete capital allocator, a master of both business analysis and market mechanics. The map is in your hands. The key to the next gate is right there. Complete your arsenal. Continue the journey.